Well, okay, it's 12:10 on the nose. We want to make sure we keep everyone on time today. Thank you so much for joining Capid Credit Union Presents the Lunch Money webinar series. And I'm very excited to have Raymond Yee back with us. Raymond was actually with us on Tuesday, June 15th for the first Lunch Money webinar. And that title was Scholarships, Finding Free Money for College. I would highly encourage you, if you were not able to be a part of that webinar, go to capidcu.com where you're actually able to register for other webinars for the following 2 weeks. And we have a recorded version of that information. Some incredible information was shared by Raymond and highly valuable. So I would love to introduce Raymond Yee. He's the Director of Relationship Management at Sallie Mae. And excited to have you here with us. Grateful for your time, Raymond. I know you have a lot of information to share with our participants today. And this webinar will actually be streamed live on Capid's Facebook page. So if you would like to view that way, that's fine, or you can stay right where you are. And also, if you're viewing this webinar right now, I would ask you to open up your chat feature and add your questions to the chat as Raymond is presenting. And at the end of the webinar, I will pose those questions to Raymond, and he may also have some additional questions that he receives commonly from parents and students that he can share with us. So with that, I am going to turn it over to Raymond, and I'm going to stop sharing my screen and go ahead, and I need to broadcast this stream on Facebook, so that will just take me one moment. So while we do that, I welcome Raymond Yee with Sallie Mae.
Thank you so much, Lisa. I appreciate the kind words. And let me share my screen here really quick, and then we can get started. All right. One more second here, and then we'll be ready to go. All right. Is the recording all set to go, Lisa?
It just needs about 5 more seconds.
Perfect. Just give me the thumbs up.
Okay. We are good to go, Raymond. Thank you.
All right. Thank you, Lisa. Hello, everybody. Thank you so much for joining us this noontime hour to talk about understanding the cost of student loan borrowing. Again, my name is Raymond. I'm a relationship manager with Sallie Mae, and really excited to be here to provide information as part of Capid Credit Union's Financial Wellbeing Seminar Series. So with that said, we'll get going here. And what we're going to learn today is we're going to cover a number of topics, and we will start with the cost of college, share some of the insights on the value of an education, and discuss how to manage the cost of paying for school, and touch on how to manage your credit as part of the whole process. Sallie Mae conducts a study every year on how America pays for college, and this is the most recent 2020 study that breaks down each funding source families use to pay for college, and it provides information on the 2019-20 academic year. You'll notice that 44% of families use parent income and savings to pay for college, along with 8% in parent borrowing. 8% comes directly from the student's income and savings, and 13% comes from the student's borrowing. We'll see here that 25% comes from scholarships and grants, and about 1% come from other relatives. What's the average cost of college? When you look at these numbers here, the College Board trends in college pricing study from 2019 indicates the following average cost. And we look here for a 2-year public institution, the average cost is around $12,700. For a 4-year public institution or university in-state, it's roughly around $22,000. And for a 4-year private institution, college or university, it's right under $50,000 at $49,870. And for a 4-year public college university out of state is around $38,300. Again, what this includes are tuition fees, room and board. Generally, there are two types of college costs, direct costs and indirect costs when you're looking at that you want to familiar yourself with. Direct costs are assessed by the school, but can vary a bit from student to student. Direct cost typically includes tuition and fees and housing and meal plans, whereas indirect costs are those that you can influence yourself based on choices that you make. Indirect cost includes books and supplies, transportation, and other miscellaneous expenses, which are usually not billed directly by the school. Earnings for graduates. Earnings for college grads continue to exceed earnings for those without a college degree. As you can see on this chart, the blue line represents the average earnings for those that have a bachelor's degree versus the yellow line below that represents of having just a high school diploma. As you can see, the value of a college education makes a tremendous difference in your earning power as you move forward in your career. Before we dive into the financial aid information, I wanted to share a quick example on why higher education is so important. In addition to getting a degree and pursuing your career and fulfill all your interests and your passions, this graph really shows lower unemployment rates associated with college and advanced degrees as compared to those with a high school diploma. It also shows a rise in relative earnings for increased levels of education. The more education and degrees that you pursue, the higher the income. These are 2019 national averages, figures gathered by the US Bureau of Labor Statistics. That's where this data came from. To give you some annual figures, a person with a high school diploma earns on average just under $39,000 a year. A person with a bachelor's degree will bring in an average earning of around $65,000 a year, and a professional degree will net someone on average of around $96,000 a year. Again, these are national averages, and some careers will pay less, some will pay more, as well as varying from regions of the country. Now, let's shift to manage the cost of education and finding scholarships and grants. As Lisa indicated, we did a session on Tuesday that talked about scholarships, but I just wanted to highlight some of the key areas here briefly as we talk about scholarships and grants. Let me first start off with grants. What are grants? Grants you do not require to be repaid and typically awarded annually based on information you provide on your FAFSA form, which is the free application for federal student aid, if you're familiar with that process. Grants are offered by a variety of sources like federal and state government, colleges and universities, and independent organizations. Federal grant programs include the federal Pell Grant and the Federal Supplemental Education Opportunity Grant, or FSEOG, a lot of acronyms here. The Pell Grants are need-based, and the awards are up to $6,345 in the academic year 2020-21, and awarded to all those that qualify. As for the Federal Supplemental Education Opportunity Grant, FSEOG, those are for students with exceptional financial need and awarded in the range of $100 up to $4,000, and is typically done on a first come first serve basis, as funds are very limited with that program. Let me talk a little bit about scholarships as a summary from in the earlier session. Some people believe that scholarships are only for athletes and scholars. In some cases, that is not true, but there are so many other opportunities. And in fact, you wouldn't believe the types of scholarships that are out there. They are almost for every skill, interest, and hobby that you might be involved in. There are scholarships out there for tall people, for short people, future filmmakers, and the list goes on. The challenge is looking for the right scholarship. If you take some time, it does take some time to go through the process, but you should know how important this is, as it is free money that you don't have to pay back, because the more free money you can get for college, the less loans that you'll need to borrow. Scholarships can be awarded in a variety of reasons, as you can see, that's listed on the slide here. I won't go through all of them. While the federal and state government awards some of the scholarships, the majority of funds that are awarded through scholarships are through the school and a lot through private organizations. Again, scholarships come in a variety of different places. In addition to the school's own scholarship, you may find scholarships that are offered through local community, federal and state agencies, religious organizations, and many more. Online search engines that aggregate scholarship offerings and allow you to match to scholarship based on personal profile can help you a lot through the scholarship search process. If you missed our session on scholarships earlier, you can listen to the recording on the CapEd website that was indicated earlier. The session again was titled Scholarships, Finding Free Money for College. So what is work study? Work study is another way to help pay for college. While most work study jobs don't necessarily lead to long-term career, you never know what experiences and connections that a job may bring to you. Again, these are jobs arranged through the school participating in the federal work study program. They're typically either on or off campus, mostly on campus. The pay is at least minimum wage, and the minimum wage rate has increased quite a bit over the last year or so. And the job usually entails limited hours. We understand that you're students and going to school full time, so it's kind of like a part-time job. It could be tied into your academic interest or your major, and often there are a wide variety of work study jobs on each campus. And students would typically receive a paycheck for their work. The work study is not deducted from the student bill. So again, it's just like having a part-time job and receiving a paycheck. We talked about finding free money first. Now let's talk about student loan options. Let me start off with the federal student loan program, and these are programs that are provided by the government and must be paid back with interest. There are two types of loans, subsidized and unsubsidized. Subsidized loans are available for undergraduate students, and in order to qualify for this loan, you must demonstrate financial need by completing the FAFSA form. If you don't qualify for the subsidized loan, then the next option would be the unsubsidized loan. A big difference between these loans is that the subsidized loan is where the government pays the interest while you are enrolled at least half time or during the grace period or during an eligible deferment time period. Whereas an unsubsidized loan, the interest is accruing as soon as the loans are dispersed to the school and the funds released to the student. Both the federal subsidized and unsubsidized loans have a 6-month grace period after you leave school before payments have to be made on those loans. With the federal direct subsidized and unsubsidized loan, the student is the borrower, and again, no cosigner is required. Again, the borrowing limits range from $5,500 for the first year as a maximum amount up to $75,000 as a maximum amount in your third or fourth year of school, which is your junior or senior year. There are benefits with special interest rates for military members regarding their federal loans. Payments, again, typically begin 6 months after leaving school or graduating or dropping below less than half time. The flexibility of repayment options are available, and the terms are up to 10 to 25 years, depending on the loan amount that you take out. There are various deferment options available, depending on your situation. And lastly, there are certain loan forgiveness options available depending on the career path that you end up moving towards once completing your college program. Over on the charts that talk about the interest rate and the fees associated with the subsidized and unsubsidized loan, again, the rate for 2020-21 is 2.75 on the subsidized and unsubsidized loan. The new rates that just came out really recently, I haven't had a chance to update the chart here, but the rates did increase to 3.73 for the 21-22 academic school year as far as the interest rate. As for the fees associated for these two loans, the sub and unsub, it's at 1.05% origination fee, and that remains the same for the 21-22 academic school year. Another source of funding the balance is a responsible private student loan program. Again, a private student loan is offered by a financial institution such as a bank, credit union, such as CapEd, or other financial companies. It is a credit-based loan, which means that the better credit rating you have, the lower interest rate you'll receive. Again, the student is the primary borrower on a private student loan. Private student loans may help students build credit, especially if payment is made while they're in school. A student starting out often are asked to have a cosigner, usually a parent. Adding a cosigner's better credit record can result in a better chance for approval on the loan with lower interest rates for that loan. Having a cosigner means that both parties share the responsibility for paying back the loan, both the student and the parent. Generally, private loans can cover up to 100% of the school's cost of attendance minus any other financial aid received by the students. Loans typically have a zero origination or disbursement fee associated with the loan. Most programs offer a cosigner release option after meeting certain requirements. I'll talk a little bit more about that. And typically there are options to defer payments while a student is in school while taking out the loan. Terms and costs vary widely between various lenders on where you take out your private loan. It is important to consider loan options that provide a variety of repayment option choices that fit your personal needs. Depending on a family's personal financial situation, a private loan with the flexibility to make low, fixed, or interest-only payments while you're in school may be the best choice over a loan repayment starting after you leave school or deferring the payment. These are key items to consider when taking out a private student loan. I'll talk a little bit more about the private student loan. And again, it can help cover the remaining college costs that you have on the tuition bill, on the bill that you receive from the school. And using private loans, we encourage borrowers to pay a certain amount if they can upfront so that they can save on the overall cost on the loan later. Making small payments while in school can result in savings on the overall total cost. Securing a creditworthy cosigner, as I mentioned earlier, may help you qualify for the loan. Again, private education loans offer a variety of in-school repayment options. I mentioned earlier, immediate repayment means making payments now while you're in school to avoid interest that gets capitalized later on. And I'll talk about interest capitalization in a little bit here. A deferred repayment, which means pay later, means that you're going to have interest that accrues on the loan and you'll end up paying it for it later on down the road, which could be at a higher amount. Fixed repayment options are available, as well as interest repayment, meaning that you can make a fixed, say, $25 a month payment while you're in school to help lower the overall cost of the loan, or making your interest payments while you're in school for, say, all 4 years, which will avoid accrued interest and interest that gets capitalized. Again, cosigners help the chances of the loans getting approved and getting a lower rate. And cosigner release options are available that I'll talk here in a little bit. Students can also choose between a fixed rate or a variable rate on their private loans. So the question comes up is, how much should I borrow? Things to consider. What is your financial situation and your future earning potential in your chosen field? It's important to know what your salary will be. How much is too much? Only borrow what you can afford to pay back later. According to many experts, students should not borrow more than their starting annual salary. And you can get additional information or get additional research data by utilizing the link that's here with www.bls.gov/OOH/. There are a few key things to consider when shopping for an educational loan. First, one of the first questions you should ask yourself before borrowing is, how much should I borrow? A good rule of thumb, again, is to try to borrow no more than your estimated first year's salary. Second, interest rates. Fixed rates have a certain appeal as they convey a sense of stability, particularly due to the fear of rising interest rate during a rising interest rate environment. While a variable rate can go up, it can also go down. Fixed rate loans are most beneficial for loans with a long lifespan, as they can provide stability throughout an extended period of time. Variable rates are more beneficial in low interest rate environments, especially if the goal is to pay the loan off sooner rather than later. Usually fixed rate loans are higher than starting variable rates, since the lender absorbs the risk of the rates increasing. We encourage you to evaluate both fixed and variable rate options. Your lenders can provide additional details if you have questions. Another element often considered when shopping for a private loan are the benefit programs. What benefit programs are offered? They will vary by lender. The most standard benefit is probably the automatic debit or ACH benefit. This benefit is offered in a form of a rate reduction, somewhere between 0.25% to 0.5%, meaning that if you get your payment set up electronically through your checking and savings account, you'll be able to reduce your interest rate, again, by anywhere from 0.25% to 0.5%. Some lenders may offer other credit upon graduation, which requires documentation of successful degree completion, and some may offer benefits for making on-time payments. Fourth, other loan features that sometimes not considered, but they all could have a big impact in terms of your overall repayment. Repayment terms, cosigner release, and death and disability waivers. Long repayment terms, as you would think, may result in more interest being paid and higher total cost of a loan. Paying loans off early helps reduce some of the costs, and there typically is no prepayment penalty when you want to pay your student loans off early. Many students who apply for student loans in their first or second year of college don't have enough credit to qualify for a private loan on their own. So by adding a credit-worthy cosigner will help you get the loan approved, and it will also reduce the interest rate that you will be charged with a credit-worthy cosigner. Many parents like the feature of a cosigner release. How a cosigner release works is that if the borrower makes a certain number of on-time payments, they can request the cosigner be released. And a lender will typically reevaluate the credit situation of the cosigner, and if they feel comfortable, then they would release the cosigner from the loan. Many parents cite that cosigner release feature made the decision to cosign up front much easier. And lastly, death and disability waivers are standard with federal loan programs, but for private loan programs, it will vary from lender to lender. And that is where the case of death and disability of the borrower and cosigner of the loan is typically forgiven. The relative cost of student loans. So what is the relative cost of a student loan? Here are some key terms to better understand. Interest rate. The interest rate, this is the rate that is charged to borrow money. The higher the interest rate, the higher the total cost of the loan. Interest capitalization occurs when unpaid interest is added to the principal amount of the loan. Increasing the principal amount will definitely increase the overall payment. Repayment incentives, this could include things like interest rate reductions or credits that we talked about earlier on your balance with certain benefits that lenders have to offer. The impact of interest capitalization that we talked about earlier is illustrated on this slide. And as you can see, the amount of a loan increases over time if the interest isn't paid throughout your education. The example that's shown here is on a $50,000 loan, interest capitalized at the end of a 12-month deferment period would be around $3,400 with an interest rate at 6.5% with a 10-year repayment term. This will increase the total cost of a loan by almost $1,300 over the life of the loan. And if you were looking at a example of $100,000, then that essentially doubles again with a end of a 12-month deferment period. Your interest would be doubled to $6,800 at a rate of 6.5% over 10 years. And again, it would increase your overall cost close to $2,600 for the life of the loan. So very key, by making payments if you can while you're in school will definitely lower the overall cost of your loan. And now let's talk about credit management. And what we'll talk about here is the importance of a FICO score. There are three major credit reporting agencies that creditors use to make decisions on whether you're a good credit risk or not. They include TransUnion, Equifax, Experian, and they use a 3-digit number based on the information on your credit report. The FICO range is from 300 to 850. It's important to know your FICO credit score, especially before applying for any credit. Components of your FICO score: loan payment history and the use of payment arrangements influence your credit score. The factors go into creating your FICO score are on this slide here, and you take a look at payment history represents 35% of your FICO score. Again, whether you've paid past credit accounts on time is what it's really measuring. 30% of your credit score consists of the amount that you owe. These are the amount of credit and loans that you are using currently. 15% of your credit score is based on the length of your credit history. How long have you had the credit? And then the remaining 20% is broken out into 10% is on new credit, and the other 10% is on your credit mix. And your credit mix consists of all your different credit that you have outstanding. It includes retail accounts, installment loans, finance company accounts, mortgage loans, and so on and so forth. As we shared with you, the 3-digit number that falls between 300 and 850, the higher score you have, the better financial position that you'll be in. So what is a good FICO score? This slide here shows if you are in the 800 range, over 800, you're in an exceptional credit status. You're well above the average score for U.S. consumers. And the average score for U.S. consumers in 2019 is 706. 706 is kind of the US average. If you're kind of in the 740 to 799 range, you're still in a very good situation. It's above the US average and demonstrates to lenders that you're a dependable borrower. If you're in that mid-range of 670 to 740, that's slightly higher than the national average, and most lenders consider this a good score. Once you get below that, a fair score is 580 to 669. Again, this is a little bit below the US average for consumers. Though lenders will approve your loans, it may be at a slightly higher rate that you'll be receiving. And anything below 580, again, this is well below the national average of US consumers, and it really demonstrates to lenders that you're a risky borrower. Why your FICO score matters. Again, 90% of all credit decisions in the US are made by your FICO score. Every time that you open a credit card account or make a car payment or create any other debt that you're adding to your credit history, ultimately, it's up to you to develop a healthy, responsible credit habits that will have a positive impact on your credit score. These are again, the three major credit reporting agencies with their toll-free numbers and their website address: Equifax, Experian, and TransUnion. Lastly, we're going to share some helpful resources for you. Again, keep good records, and here's kind of a tip sheet here. Get all your loan documents together. Keep them all in one file. Your promissory notes, your disclosure statements, your award offers. Again, keep a good record file of all your documentation. Read and open all of your student loan information. It's helpful to bookmark your loan servicer website so you have easy access to them, along with keeping their phone numbers available in case you need to make a phone call inquiring about your loans. If you move or change names or anything, and you please notify your loan servicers as soon as possible. They want to make sure they have the most current information on record about you. Keep careful notes on any calls that you make to your servicer. Get their contact name and have them as a reference down the road if something comes up. The Intuit mint.com is a great resource for tracking, is a great resource as a tracking and budgeting tool. So if you have an opportunity to look at some resources, mint.com is a really good resource that you can check out. It's pretty easy to find your federal and private student loans. Again, for the federal loans, you can find information by going to the Federal Student Aid website, which is studentaid.gov, and you can just log in and it will identify all of your federal loans. As for private student loans, they're reported to the National Consumer Reporting Agencies, and you can find yours by going to www.annualcreditreport.com, and you can also receive a free credit report on an annual basis by going onto that website. Here are some great resources for you to know about. Your financial aid office is always a great resource and available to point you in the right direction. Listed here also talks about the lender servicer information that we gave earlier. The Federal Student Aid Ombudsman through the Department of Education is a great resource for federal loans. And again, the servicers are listed here as well on servicing any of your federal loans. Again, as far as for private loans, the best resource to go there is to the lender that you've taken your loans out through, and also through the credit reporting agencies. So with that said, Lisa, I think we're getting close to our time here, and that brings us to the end of my piece. So let me turn it back over to you to see if there are any questions that came up through chat.
Great. Thank you, Raymond. Oh my goodness, that was just a wealth of information. I learned numerous items. There was a question in the chat, and you briefly touched on it. The question was, how many times can I check my credit score for free each year? And I do know that you listed the annualcreditreport.com, which I know that we can pull. You can go to annualcreditreport.com and you are eligible to receive 3 credit reports each year. And that way, that's a nice way. I encourage people to do that almost in a seasonal manner, so that you're checking it maybe in the fall and the spring or the winter, so that you have an idea of what's happening with your credit report. But this question was more on the score.
No, great question. Let me add something to that as well. If a student takes out a private loan through CapEd, we will provide a quarterly credit report or a FICO score to the individual, again, on a quarterly basis. So that's one of the benefits of taking a private loan out through CapEd, is that you'll receive a quarterly report that will identify kind of where things are sitting with regard to your credit. So good question.
Yeah, thank you. And if you wouldn't mind, if you want to stop screen sharing, I will pull up your information. For those of you that have questions specifically for Raymond, I'm going to put his information up on the screen. And Raymond welcomes phone calls and also email. And here's the information here. So Raymond Yee, Director, Relationship Management at Sallie Mae, Raymond.Yee at salliemae.com. And his phone number is also listed, but I would think, do you welcome either, Raymond? Do you have a preference?
Email would be the best, because that's quick. And yeah, so any questions, feel free to email me at that email address.
Wonderful. We appreciate that. Our next Lunch Money webinar is scheduled for this Tuesday, June 22nd. That one is titled What's Happening in the Treasure and Magic Valley Real Estate Markets. We will also have another one on June 24th, and then the following week, they will be Tuesday, Thursday. So we have 4 more webinars left. I would highly encourage you to go back and review and watch the recorded version of today. There was so much wonderful information in there, Raymond. One quick question that I seem to hear is, there's a student who is just getting their first job and they want to apply for that loan and they actually don't have a cosigner. I like that you can actually have a cosigner release after you've made so many payments, but what do you encourage students to do who have no credit score and they actually don't have someone to cosign for them?
A good question, very good question. It comes up quite frequently. A cosigner, by not having credit, doesn't mean that you're a bad borrower or a bad risk. It just simply means to a lender that there's just not enough information to go with to determine approval. So when they look at a cosigner, it doesn't necessarily have to be a parent. It can be a grandparent. It can be a older sibling. It could be aunt, uncle, somebody close to the family. Really, it's somebody that may have a vested interest for you to succeed in higher education, of going to college, and want to see you through. That's probably the best person to maybe ask and say, hey, this is what I'm wanting to do, going to college, and this is what I'm going to study, and this is what I want to be when I finish, but I really need some assistance to getting it paid for. Would you be willing to help cosign on my loan? And then you can talk about the cosigner release feature that says that once you graduate and you make a certain number of payments on time, that cosigner can be considered to be released from the loan. I think if you find somebody that has that shared vested interest and wanting you to be successful in college, they might be very willing to help you with that process.
Great, thank you. And again, please feel free to reach out to Raymond directly for additional questions. This will be recorded, so you can go back and find his information. But again, there's that page there. And with that, Raymond, if you have anything else that you'd like to add, otherwise we'll let everyone go on with their day. And thank you so much for joining us. It was a pleasure having you.
Thank you. Thank you. I appreciate it. Yeah, just take advantage of the recordings, wealth of information. I know I went through a lot of information there, but any questions, again, feel free to reach out via email to me, and I'd be happy to talk with you.
Wonderful.
Thank you.
Thank you. Thank you so much. Have a great day, everyone.
Bye already.